Welcome back to the Neuro Finance Masterclass. We are officially on day 62 of the 365 Days to Financial Freedom series. And wow, in today's explainer, we're really embarking on a massive shift.
We really are. Look, for the last 61 days, we've basically been arming you with the micro tools of technical analysis. You know exactly how to read candlesticks, you totally understand the RSI, and you can map out support lines like a pro. But today we zoom out. We're looking at the overarching macro environment.
Yeah, just think about the stark contrast between these two worlds. On the micro level, you've got your candlesticks and your RSI, but on the macro level, well, you're dealing with the actual economic weather.
Right, and here's the hard truth, guys. You can have the most beautiful, perfectly drawn technical chart in the entire world, but it's absolutely useless. I mean, totally useless if you ignore that macroeconomic weather. Think about it. If there's a Category 5 economic hurricane brewing out there, your perfectly drawn support line is not going to save your portfolio. You really have to understand the broader environment.
Which brings us right to Section 1, the masters of the universe. Let's meet the central banks.
So to really grasp this economic weather, you have to look at the Federal Reserve. They're the ultimate authorities in the financial system. They don't just participate in the market, they literally create the environment in which it exists. And they pull the strings of the global economy through one primary mechanism.
And that mechanism is the interest rate. Simply put, the interest rate is the absolute price tag on money itself. That's right, money actually has a price.
It's kind of staggering when you really think about it, but this single number dictates the direction of the entire global stock market. Seriously, a mere 0.25% hike can wipe out billions in corporate value in a matter of seconds.
Exactly. Just think about it for a second. If a massive corporation wants to build a huge new factory, the interest rate decides if they can even afford the loan. If an everyday consumer wants to buy a house or a car, the interest rate dictates their monthly payment. Because it impacts borrowing at literally every single level of society, it's the undisputed king of all financial metrics.
Moving on to Section 2, Buffett's financial gravity, the universal law of valuations.
You know, nobody explains this concept better than the legendary investor Warren Buffett. He famously said, "Interest rates act on financial valuations the way gravity acts on matter." I absolutely love this analogy. Don't just think of rates as boring spreadsheet numbers. Try to visualize them as this massive, world-altering gravity dial controlled directly by the Fed. When they turn that dial, the physics of the entire financial universe just shift instantly. So let's imagine turning that dial. Under high gravity, like when the central bank actually raises rates, money suddenly becomes extremely expensive to borrow. Companies stop expanding, corporate profits start to drop, and that heavy, heavy gravity pulls us directly into a bear market. But then, flip that to low gravity. When the Fed lowers rates, money is suddenly incredibly cheap. Companies borrow billions, consumers max out their credit, and all that extra cash floods directly into the stock market, which fuels a massive bull market. It's like flipping a switch.
And that leads us to Section 3, the golden rule, respecting the gravity dial.
Don't fight the Fed. Honestly, that is the oldest, most reliable rule on Wall Street. If the central bank is actively turning up the gravity dial by raising rates, do not expect your portfolio to skyrocket.
For sure. Expecting a massive boom during a rapid rate hike cycle is literally like stepping off a building and trying to fight gravity. You just cannot fight the Fed. You absolutely must align your trades with the direction the central bank is moving.
So let's look at Section 4, the architect's awareness, from microvision to macro strategy.
All right, so it's time to elevate your mindset from just a daily chart watcher to a true architect. Here is your Neuro Fitness action plan. Step 1, watch the central bank's interest rate decision. That is basically your ultimate weather forecast.
Right. And Step 2, are rates climbing? If gravity is increasing, your discipline should tell you to be cautious, hold back, save your cash, and build up your dry powder.
Exactly. And Step 3, are rates dropping? Because when gravity is turned off, money is cheap. And that is the exact moment you want to deploy your capital aggressively and ride that incoming wave.
So we're going to leave you with this final, really crucial question. Are you just checking the charts? Or are you actually checking the weather?
Think about that. If you really commit to understanding this macro gravity and align your strategies with the central banks, you are going to see the storm way before it even hits.
Absolutely crucial. Thanks so much for joining us for this explainer on day 62 of the 365 Days to Financial Freedom series. Respect the gravity of money, guys, and we will see you tomorrow for day 63.